Good morning, ladies and gentlemen, and welcome to the show on this Thursday, the 11th of August, 2022. Thank you for tuning in. I'm glad to have you guys here. Now, what I'm going to do this morning is I'm going to run over the markets real quick, starting right away. Now, after I'm done, I'm going to try to give an explanation in simple terms, kind of what's going on, more or less, within the financial system and why the financial system actually has to fail. Okay, so let's get started. Let's open up the charts right here. Take a look at what's going on in these markets today. First, the silver price today, 20.52, and it's down 7 cents on the day so far. We're going to take a look now at the gold price. Gold is $17.95, and it's up $3.30. I've been noticing a little discrepancy between gold and silver as of lately. Gold's been moving up a little bit more than silver typically. Silver's been lagging behind a little bit. People out there are buying into gold a little bit more than silver because gold is your premier safe haven asset in the entire world. And when they get a little bit nervous about the financial system, nervous that things might turn over suddenly and they don't know from where it might start or whatever, they tend to buy gold. Physical gold, you know. Let's move on. Take a look at cryptocurrency today. And what we're seeing here is cryptos are up to at 1166 billion. That's $1,166 billion with a Bitcoin price of 24,700. Now, yesterday I was reporting on this and it was hovering right around 24,000. Now it's gained another $700 or so since yesterday. Ethereum's getting up really close to 2,000, 1,911 today. So cryptos are starting to gain again. The Dow Jones Industrial Average today, and she's up 289 points at 33,599, which is a pretty good little gain. Well, it looks like the bottom was put in around 30,000 for now. In the short term, we're going to have to wait and see. You know, the Fed, as long as the markets remain relatively stable, you got the Dow going up a little bit, you got the indices, the other indices going up a little bit. The Dow's, I think that the Fed's going to remain hawkish, and they're going to be talking about quantitative tightening, and they're going to be talking about, so we're right back where we were before with all this. In the fact that sooner or later, if they keep pushing at these things, and this is what I'm going to explain at the end of this show, why this has to happen, there's going to be a real pivot with the, I really can't see them extending this past the end of the year before all this folds, and they have to pivot in the opposite direction toward being dovish again. So 285 points up today on the Dow. We're looking at crude oil today. It's up $1.61, which is a big jump for crude at 93.54. Move index today. And this is interesting. We've seen a little drop in the move index. It's down 115, down to 115. We're right on that line where if you basically you draw a line, we're right on the spot right now. If it goes any lower than that, it's going to go below the trend line. It's right on the trend line right now, on the moving average. You just tell by looking at that chart. It's right on that trend line. And you can draw the line with your mind straight up this way, you know. And if it drops any lower than that, it's going to drop below the trend line, just like at charting anything. Bonds and rates today. We're looking at the U.S. 10-year at 2.819. Well, pretty much, yeah, well, there it is, 2.82. We got it, rising yields on the long end of the yield curve. We've got rising yields. So 2.826 right now on the U.S. 10-year. It's up 4.5 basis points. U.S. 30-year is 3.1, and it's up 5.8 basis points on the day so far. dollar index, we're at 104.81 on the US dollar index, and the dollar's trending downwards today. Okay, I'm going to try to do this explanation. Pretend. We're going to move it onto a small scale so you guys can understand it better. Pretend that there was a big credit card company. Let's call them Acme Credit. Just like in the Roadrunner and Bugs Bunny, you know, Acme. You remember he used to buy all these Acme things? So you got Acme Credit, okay? And they extend credit to this guy. And they offer him 4 premium credit cards, you know? And they extend him that line of credit. And so he gets these 4 cards, and he could get $10,000 on each card. Okay, so the guy takes these cards out and he cashes them all in for everything he can get on them. So he's got a pile of money laying on the table, some $50,000, and he loses his job. And so then he starts to use that $50,000 that he had borrowed to live his life, okay, on Acme Credit. So after he used that money for a while, and it lasted him quite a while, he was getting a long ways into it, he didn't even have a quarter of it left, you know, going through that cash. The credit card company said to him, okay, we're going to extend your line of credit higher. Instead of $10,000, we're going to offer you now $20,000 on each card, you know. And so what he does is he borrows it up to the limit again. And the Acme credit card company is charging him this high rate of interest, and he's also paying off the credit cards as best he can with money he's borrowed off of the same credit cards. Of course, we all know people that have actually done this in real life. They go out and they get a new card and they use it to pay off their older cards. Okay? So that's what he's doing, basically. And after a while, it gets so he can't make the minimum payments. But the Acme company keeps extending him a higher rate of credit. But they keep the interest rate that he's paying on those credit cards rather high. And this is why he can't make the minimum payment on his credit cards. Well, basically what's happened is the governments that are being run under these central banks, they've borrowed on a line of credit for all of the people too. People and governments around the world, central banks have borrowed on a line of credit. And as long as the interest rate remains low, they can continue to pay on these lines of credit. Well, this is where the central banks come in. This is why they can't raise interest rates too high, is because now what's happened is they've borrowed such an exceedingly large amount that the whole system is dependent upon this. See, the credit card companies, when you had this one individual, an Acme Credit, and he was extending this guy $50,000 or whatever, or $100,000, they could foreclose on him. And they can keep the interest rate high because they don't care. They just want their money and they can foreclose on him. It's not going to destroy the economy or anything like that. But with these central banks, what they've done is they've extended so much credit out over such a wide area that they will go down too if it defaults on all of this. In other words, it's way bigger. It's a way bigger situation. So what they have to do now at this point, because it's so large, just the United States amount of credit the United States has alone is so large, they have to keep interest rates down low in order to service this debt. In other words, in order to make their minimum month, well, they don't have a monthly, more of a yearly type of payment, but in order to make their payments on the amount of debt outstanding, they have to keep those interest rates down low. Eventually, low is not going to be good enough because the outstanding amount of debt, because they have to keep growing this debt in order to keep the system running. Just like that man had to keep borrowing on his credit cards in order to keep going. They have to keep, and every time the debt ceiling comes, you've all heard about the debt ceiling before. They have to go higher. Otherwise, Janet Yellen gets up there and she says, oh my goodness, we're going to default on the debt and the whole country's going to go down. And everything's going to be a major disaster and everything, unless they raise the debt ceiling. And the Treasury Secretary is all upset. Steve Mnuchin, or whatever his name was, he was all, before Janet Yellen, he was all upset too. Every time the debt ceiling would come due, they'd all get upset and they'd all be tearing their hair out until they raised that ceiling. Basically extending the credits. It's very similar to the man who's constantly getting the credit card company to give him more credit. And he borrows more. There's a time coming in the very near future where they are going to have to bring the interest rate down to a point where it's going to end up going negative in order to pay all this. So that, and this is where I have problem in my mind understanding how this even works, is when you get negative interest rates, deeply negative interest rates. Then the people who've borrowed money actually make money on how much they've borrowed. It's so backwards to the way things should work that I even have trouble understanding it. But I do understand enough about it where I realize that it's like the man who has a credit card and he borrowed from Acme. He borrowed this tremendous amount of money, say $200,000 or say $100,000. He's borrowed 2 tranches of $50,000 and he's been living off of that money. Say Acme were to say, hey, we don't want you to go bankrupt. We know you've been charging you like 12% per year, right? We're going to lower that rate down. How would you like it if we brought it right down to 1% per year? Could you manage to make the payments on them credit cards if it's only 1% per year? And the guy says, yeah, I can if you bring it down that low. But then they increase his limit again. Instead of borrowing $100,000, say he borrows $500,000. So then even the 1% per year is straining him, right? So then Acme comes along again and says, okay, 1% per year. What we're going to do is we're going to lower it down to 0. Well, we've been at 0 for a long time in the system. And then they come along later and they say, okay, you can't manage at 0% anymore. How much have we lent you now? Oh, we've lent you $5 million? Oh, okay. We'll make it negative 1%. How about that? And the guy sits there and he says, hey, I've borrowed $5 million off of the Acme credit card company. And he says, they're going to give me 1% per year off the $5 million. And he starts adding up in his head. I can use that to pay off the outstanding balance. That 1% on $5 million. Which is, I think it's what would be $25,000 a year for nothing, just getting free money. They make it 2%, they double that. 2% negative. So when this thing starts to go into the negative, like I say, I don't understand it. I'm just sitting here with you guys trying to figure the heck out. It seems to me that all the big debt, the United States debt and everything, the more debt that they have, the more money they're going to make if they start to go deeply negative. So is this what it's all about? Is this why they're trying to get rid of cash? Because savers, now on the opposite side of this coin, see, the people who have debt, they're going to get paid. I know, it's absolutely crazy. The people who have debt are going to get paid, right? And the people who have, when rates go negative, the people who have money in the bank are going to get charged. So is this the reason why the people are trying to get rid of dollars, trying to get rid of cash? Because they know that eventually they're going to have to go into this crazy upside down banking system where we have deeply negative rates, real rates. They call it NIRP, negative interest rate policy, because it'll cause bank runs. Once it goes below, say, let's say 2% negative, plus we still got inflation going on, people are going to say, oh, I'm getting my money out of the bank. They go into the bank to get their money, and there's no cash. How can they withdraw their money? The only thing that they can do is purchase things with it or whatever. But if there's no cash, and I know this is hard for us to understand too, but it might be the banking system, it might be looking ahead, and they've got all this stuff figured out already. Like, I'm the guy that doesn't know how it works. I'm just sitting here with you guys trying to figure it out. But they got it all figured out already. They know exactly what they're going to do. And this might be where they're going to go. Maybe this is why they've been pushing to get rid of cash for so long, is because they're planning on having these negative rates where people who have borrowed a lot of money are going to get paid for borrowed money, but the savers are going to get cut the opposite direction. They're going to get money taken away from them. An upside down world. A world where you don't have any savers anymore. All you have is people who are in debt, and the deeper in debt they are, the richer they're going to become. But they have to be hooked up so that they are extended a line of credit. And maybe they just say to themselves, the banks say to themselves, okay, there's only going to be certain people that we're going to extend the line of credit to. And everybody else can go boop, 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 you know? And the people that have a line of credit extended to them, the more they borrow, the more money they're going to make on deeply negative rates. I think that's how it works. You know, it just works exactly the opposite from the way it used to work, where we used to have positive rate of return on our money, like, say, 4% rate of interest per year, and then you make 4% on the outstanding balance of the money you have saved. That's normal. But negative rates, negative 4%, it's just exactly the opposite. If you got money in the bank, they're going to charge you 4% or 2% per year on whatever outstanding balance you have in your account. And the people who are owing money, they're going to make the 4%. So looking at that, you say to yourself, well, who's the biggest borrower of all? The United States government. So they're going to be making the most. I know it's totally upside down. But it's like when they changed to negative rates, and I don't see any other choice. I mean, at this point, this is the only way that they can keep this game going a bit longer. And the only other way I can see them keeping this game going a little bit longer with the inflation is if they go over to electronic money and get rid of cash and everything. Then what they can do is they can move the decimal point around on the money, and they can just basically make $1,000 into $1 again. They can just move the decimal point over a little bit, and so basically you treat $1,000 like it's $1 bill, and then they can even make it more. You treat $1 million like it's a $1 bill, but $1 million of the old dollars. And so this means people are constantly being refreshed with their money. It means that absolutely you cannot get ahead in a system like that because your money's losing value. There's no way you can save to get ahead. You're going to have to constantly keep moving with the system. You know? Because if you don't got that fresh money coming in, because prices will just keep going higher and higher and higher. So if you had savings, that savings would just be eaten away with inflation. But they can just keep that inflation going and going and going for who knows how long. Maybe this is their plan. And this is why they want a central bank digital currency so much. Is to just make it into an inflation nation and destroy the purchasing power of their fiat currencies more and more as time progresses. But the trap in all this is the things that can be used as a means of payment outside their inflating system. So they got this inflating system, and they're going on, the dollar's being worth less and less and less year after year after year, which is what they already have, by the way. But let's say it gets really bad, you know, and they just keep going forward with this. Well, all these payment systems outside the dollar-based system will have to, in the end, silver, gold, cryptos, they'll have to go up in the end in value. So this would be a faster and faster process of them going up in value as they move forward with this crazy system of theirs of negative interest rates and money that's being eaten away with inflation. As they move forward with this, ultimately, in the end, you're gonna hit the spot where these other asset classes are going up, and people are going to take notice of that, and they're going to want to buy in. That makes them go up faster. And so, in the end of this game, you're going to have a wealth transfer. Because all these other things, these other asset classes that you can trade in, and they might try to make it illegal, but people will do it anyway because there's so much money involved. It's called black market. They've never been able to get rid of black markets around the world forever. It's endless how high they can go. When you got a system that's bound and determined to inflate the purchasing power away of the fiat currencies. And how far can they go with this game before finally they have to throw in the towel? I don't know. I mean, by that time an apple might be $1 million. But we already see this progression. We've saw it since 1913 till now. And the dollar's lost 98% of its purchasing power. I mean, I remember a time, and I'm not an extremely old man, but I remember a time when you could go to the grocery store and for $1 or $2, you could pretty much fill your cart with stuff just for a couple bucks. Now, if you go in there with $200 and your cart's only less than half full. Way less than half full. I mean, to fill a grocery cart now might cost you, I don't know, maybe $1,000 to fill it. You know, with things like meat and things like that. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the next episode. Bye-bye.